If you're trading supply and demand using 5 different strategies, indicators, and timeframes, then this video is going to save you years. I only trade basic supply and demand on the higher timeframes, and I use the same exact framework across currencies, commodities, and indices. No indicators, no fancy candlestick patterns, and no strategy hopping. So in this video, I'm going to show you the only supply and demand setups that I trade and how I filter for high probability trades using cross asset alignment. Now guys, what I'm going to show you in this video will literally make you a profitable trader. It's just higher time frame supply and demand. It's a really simple concept, but 99% of the content I see on YouTube or social media teaches these concepts incorrectly. Now, I tend to trade the higher time frames. I don't want to go below the 4-hour. I predominantly spend my time on the daily time frame. And supply and demand on the higher time frame carries way more weight than those lower time frame zones. For me, the lower time frame simply is just more noise. There's loads of levels all over the place. It's difficult to decide which one you want to trade and which one you don't. And it's messy. It takes a lot of chart time, a lot of screen time. The higher time frame is the real institutional positioning. Now, I can only speak from what I was taught, and I was taught by an ex-Goldman Sachs trader that told me that the traders that lasted in the CME on the floor in the pit were the traders that were utilizing higher time frame levels. The guys that were trading on the lower time frames didn't last long. And for me, one good zone beats 10 weak zones. If I have 1 or 2 good zones per week, I know that my win rate is high and my potential risk reward is even high. So it becomes a very strong, solid strategy. Okay guys, so I'm going to start really simple. We're on the daily time frame. We're on Euro US dollar. Now, if you don't know how to draw a supply and demand zone, go back to my first video. I show you exactly how to do it. It's very simple. But if I'm just to draw some basic levels that have been tapped previously on this chart, I'm not going to cherry pick these. I'll just draw all the ones that we have here that are valid. We have even some back this way. So there's one here. There's one here. And you can see that all these levels are relevant highs and lows within the market. There'll no doubt be a refined one within this wick somewhere. There's also others which we haven't had tapped yet, like this one has been tapped, but this one hasn't, for example. But just look at how the market responds to these levels. And yeah, you do have to wait days because these are daily candles, but that's fine. There is a direct correlation between all broker data from the 1980s to today, and even some of the prop firms that I'm working with currently, that shows that the more trades you take, the less money you make. You can literally see the correlation. As a trader takes more trades, their P&L curve inverts and starts to go down. So you've got to consider that less is more in trading, and finding the better zones is where your edge will lie. Now look at this zone here. We've come in and tapped that zone and reacted to the downside. If we go back and we start the first one, you can see we had this one here. Market came in, didn't quite tap the zone. I mean, debatably tap the zone. Tap this one here. If you look at that one there, there is an area there that was tapped, but not this one here. And then, okay, we did breach here. So there's a big bullish candle through there, which was no doubt fundamentally driven. And we'll talk a bit about that zone in a minute. This zone here, price pushed away. We tapped back in here. We reacted again. Multiple times there were reactions. This zone here, we tapped in once, almost pit perfectly. We tapped in again here, big move to the upside. This zone here that we drew out, or in fact this one, sorry, we pushed away, we came back in, we reacted. This one here, we pushed away, we reacted. This one here, we pushed away, we reacted. There's so many zones on this chart that you can see reactions from, and obviously not every zone is going to work, but also not every zone is created equal. Not every zone on this chart is worth us trading. There is one element which I'll cover further in this video as well, and I'll offer you guys a free PDF which will help clear up and understand that principle. Now if we go to the lower time frame, so if I drop to a 15-minute chart, we just do the same thing. You can see how many levels we're already going to have to plot. Now you have to ask yourself two things. One is, why would a 15-minute level hold over a daily level? It probably wouldn't. A daily level is going to have a lot more weight. There's going to be a lot more institutional volume coming from those big daily swing points. But also, why did you get into trading in the first place? Did you get into trading because you want to sit glued to a chart all day, taking 20 trades and hoping the probability pays you? Or did you get into trading because you want to spend more time doing other things and you want to take a couple of trades a week, get funding through prop firms, or manage your own capital and grow it steadily? For me, it's the latter. I want to be trading stress-free, relaxed, clear-minded, and executing just one or two good trades per week. So if we start drawing levels out here, you can see how many that we have to consider. There's one up here. There's no doubt a refined one up here. There is loads of zones over here. I mean, it's overwhelming to even just try and draw these levels on here. There's just so many of them. There's one over here. We've even got levels forming now, just one here. You know, there are so many zones here to draw. And it becomes really tricky to know which ones to trade, which ones not to trade. And realistically, if you want to trade every 15-minute area of supply and demand, you need to be glued to your screens 24/5. You know, from when the market opens Monday morning, Sunday night, whenever you start trading here, GMT, it opens on a Sunday evening. You need to be fixed on those screens till Friday, because if you're cherry picking setups just based on when you're actually on the charts, there's a strong possibility that you'll pick all the losers and miss all the winners. So to let those probabilities play out, you have to be fixed on the screens all the time. Now that's completely overwhelming for me. That's not something I want to do. And it's also not something I was taught. I was taught that the big institutional traders are trading the higher time frame supply and demand zones. So that's how I've traded for the last 13 years. Now, before we go into what makes a good level and what makes a bad level, let's take a look at one of the concepts that I use heavily in my trading, and that is cross-asset alignment. Now, something I teach my mentees is how to identify what is rotating in the market, where the money's moving. Because if there is money moving in investors' pensions and 401ks, and we're seeing a stock market sell-off, then because you've drawn a line or a level of supply or demand on euro US dollar, doesn't mean the market's going to stop there. No investor, no money is moving in that market. It's being moved inadvertently by a stock sell-off or by a risk incentive, by a risk move. So your analysis becomes obsolete in those scenarios. And to understand that further, just go under this video, download my free PDF, and you'll get an understanding of when risk rotations are occurring, but also how to utilize cross-asset alignment and combine instruments to make your zones more effective. And this is just a really simple example here. On euro US dollar, we can see that price moved in to this clear area of supply that we just marked off. Very, very simple. When price moved into that zone, if we simply look at a Dixie chart, you can see that at the exact same time, price was pushing in to this area of demand. There is an inverse correlation between Dixie and euro US dollar. Euro US dollar is the most traded FX pair. There's a lot of institutional volume going through that market. And we've had cross-asset alignment with the Dixie driving into a clear area of demand. Very, very simple. There are a couple of other elements that I teach my mentees in terms of price and other confluences that we look for. But in very simple terms, that's exactly how we find an area of supply or demand. We use multiple instruments to confirm that area. Well, this is really crucial, and this is where I think all the YouTube content out there misses something really valuable. A few valuable key points. The first is that there must be a strong impulsive move away. So what do we mean by that? Well, we simply mean that when the market forms the supply or demand, we have to see a strong move away from the zone. What does that indicate? That indicates that institutional money was long or short at that zone, and they drove price away because retail are not moving the market. The money that's moving the market is institutional, and there is minimal overlap. Now, this is often talked about, but what does it mean? Minimal overlap means that it's another way of saying there was a strong impulsive move away, but minimal overlap means that there weren't wicks going back into the zone. It wasn't a messy zone. It's a clear area of supply or demand. Prices moved away impulsively, and we're looking at trading it because we think that there are orders left over when we get back to that level. If you think logically, the reason we're trading supply and demand zones is simply because institutional volume moved price away from the level without filling all their orders. When price revisits the level, we expect there still to be some institutional volume left in that zone to move the market a second time. And the move away has to break structure or clear the range. If the move away is insignificant, if we don't form a new low, we don't form a new high, if we can't clear the basic range or at least get to the top or bottom of the range, then it just shows that there wasn't a lot of volume pushing the market away from that zone. So the zone that's formed itself is a lot weaker. Now, this is something that everybody talks about nowadays, and it's inefficiency. Everybody talks about fair value gaps. All it is market inefficiency. If we form an area of supply or demand, the market drives away aggressively, it will likely leave inefficiency, and they're what retail traders call fair value gaps. But again, it all links back to that strong impulsive move away that we're looking for. Then you hear a lot of traders talk about a zone being fresh. Well, that means the zone is untouched since the creation. Now, if you think logically, when price pushes back into the zone and it wicks and it taps it, if it fills those remaining institutional orders, when it comes in a third time, we don't want to be taking that trade because we can accept that the likelihood of there being more institutional volume left in the zone has been reduced. So we're losing some of our edge there. The probabilities aren't necessarily in our favor. So we want to trade the zone once. Once it's been traded once, we move on to the next zone. And if one of these is missing, you just move on. You pass the zone. You don't trade it. But these are the 5 key points that most people miss. There is one other, and that's zone authenticity. That's when a zone has been tapped multiple times and it's created another zone or more zones, but we'll look at that in a second on the charts. Okay, so using our very basic Euro US dollar example here, I'm just going to run through those points. Now, we already know that we had cross-asset alignment when we got to the zone. But when we actually look at the zone itself, why would we be interested in that area? Well, firstly, was there a strong impulsive move away? Yes, absolutely. If we measure the next 2 daily candles, we can see that there was a huge move. It was 174 pips on Euro US dollar. At this point in time, it had roughly a 50 pip ATR. So we've moved nearly 4 times, 3.5 times ATR away from that zone in 2 days. Huge move to the downside. Now, was there any overlap? What do we mean by overlap? Overlap just means that was the zone tapped or retested initially when it was formed? No, it wasn't. It's a very clean zone, that. All that is a simple base and a drop. The market rallied, it based, then it dropped aggressively. Dropped aggressively, took out this previous structure, and there was clearly no overlap in the zone. It's very, very clean. So did it break structure or clear the range? Yes, absolutely. We could mark off basic levels here, like this one or this one. It took out both those levels. It took out this one, it took out this one. Now, to give you guys an example here, would this area, if we refined it, be strong demand? No, because look, the market pushed to the upside. Did it take out any structure? No, it didn't take anything out. It's not strong. It's not something we look at. So we wouldn't trade that. Now, did the market leave an inefficiency? Fair value gap traders? Yes, you can see there was a clear one there. Market made this high. We had an aggressive push to the downside. We didn't come back and fill orders. We just continued to drop and we left what you guys call a fair value gap, what I call an inefficiency. And has the zone been touched since creation? Well, if we look to the right, we have not got back into that zone. Not once until here. So we are taking the first retest of that zone. After that, we're no longer interested in it. Simple as that. So that one meets all of our criteria. Then we combine that with cross-asset alignment. You have a winning strategy. I've literally just taught you a profitable strategy that myself and all of my mentees used to get funded or used to trade profitably. Now, there are a few other elements to this edge, and I would be doing my mentees a disservice if I taught them all for free on YouTube. But everything I've shown you there, you can carry forward and become profitable as a trader. If you want to see some more examples or learn more, or jump in my free Discord below where I post some of the trades that we've taken within my community and that my mentees have taken to secure payouts, funding, and ultimately have made them profitable traders.